In this video, I'm going to show you how you can make 100% returns in just 30 days with as little as $1,000 down. I'm going to walk you through a case study of a company called NextTracker, where we invested right before the earnings release. The stock revalued 30%, and we used options to boost that return to 100%. Now, I'm going to show you the strategy and what to look for and how to structure this type of investment. And this is one of the many ways that you can make money in the stock market using the skill set of an investor. The great thing about this strategy is that it's fast. I started with just a small $25,000 account at the beginning of 2025. I set that up to compete in the US Investing Championship. You can see on the top, there's NXT, that's NextTracker, and there's the call that we used to make $2,000 on just a $2,000 cost basis, so a 100% return. Now, you can apply this strategy to $1,000 for a small account and even up to $100,000 or $1 million or more with a big account. The nice thing about investing is that it can scale, because a lot of these companies, they trade in multi-million dollars in liquidity every single day. So that means you can really add on size with this strategy. So I learned this working as an equity research analyst in New York at BMO Capital Markets, so Bank of Montreal, in New York City, working with hedge funds and asset managers, helping them pick stocks. So I've been covering stocks for many years, and I've seen this pattern happen over and over and over again. So what we're looking for is a company that is about to revalue. Now, this ideal setup here is one, we're looking for a company with good growth prospects. You need that for the stock to go up. We're looking for a stock that has low expectations, so it's not pricing in any of that opportunity. And 3, we're looking for a discounted valuation, a cheap stock which lowers our risks and gives us a better return. So why does this work? Well, every financial asset, you can think of it as a combination of fundamentals. So that would be the business and the earnings that it makes, and the expectations. So you can think of it also like sentiment, and that describes how the price is reflecting the actual business. And the stock price revalues when the outlook for the business's earnings improves. That's the fundamental side. And also when the expectations, and usually we're looking at things like the estimates of the company's earnings, also increase as well. Put those together and the stock moves up. So NextTracker, the case study we're looking at, had all 3 of those elements at this certain point in time. And an investor in our accelerator program actually found this. So got to give a shout out to Darren. So that's a great find. Now, just for background, it's a small energy tech solar company. They make these solar trackers that tilt solar panels just to make the solar projects more efficient. So first, we want to look for a company with good growth prospects. So there's 3 kind of basic things that you want to be looking for. 1 is it has a growth story. 2 is that the business is actually profitable. And 3, that it's making returns. So from a growth perspective, I actually got interested in this from reading an article in The Economist. It was on the solar industry. And it turns out solar is actually the fastest growing energy source in terms of build out of production as a power source in the US. And the reason why is just because it's actually the cheapest. And of course, it's renewable. So solar is growing really fast. And there's a ton of demand for power and electricity. Now, when I look into the financials of looking at NextTracker, we can see that the revenue growth is really high. It's growing between 20 and 40%, and that's reflecting the build out of these solar projects in the US. Now, from a profitability perspective, the company is making lots of profits. The margins look quite good. Looking at gross margins, EBITDA margins, that's like the operating margins or the margins of the business before non-cash expenses. They're both positive, and more importantly, they're expanding. The reason why is this company has actually been able to lower the cost of its productions, so it's becoming more profitable. And all of that translates into earnings growth. So you can see the EPS number on the bottom, that's earnings per share, has grown by a ton. So it's a great growth story. From the return perspective, the returns of this company are actually really great. If I'm looking at the return on invested capital, or ROIC for short, it's been expanding. And it's also at a really high level as well. And so it turns out what they're doing is they're partnering with manufacturers so they don't have to spend a lot of capital. They've lowered costs and they focus more on the technology components of this product. So they're selling it at a much higher value. And so all of that translates into a lot of good profits with not a lot of capital invested. That leads to great returns. And great returns over time leads to really great earnings for a company. So that's why we look at that. Now, the second thing we want to look at is the stock side. We want to see if the expectations for the stock are low. Now, the reason why we want to do that, because if they're low, there's more of a chance that the stock is not pricing in something good. If it's pricing in something good, it's going to go up. So you can basically look for three examples. One is that the business has some sort of temporary weakness, brings the stock price down. Two is that maybe that there's some sort of new growth development. It's not really being reflected in the price yet. Third is that there's just low estimates for earnings growth. Now, a clear sign when you look at a stock chart of, say, Nextracker, is that the stock price is going down. So it's probably clear that expectations are declining for the stock. Now, the key thing here is we need to understand what's actually driving those lower expectations. So first thing I usually look at is the financials. So when I look at that period in time on a quarterly basis, you can see that one thing really stands out is that they had a big slowdown in growth in about 2Q. You can see a slowdown from 50% to 10%. And what was actually going on is there was a delay in shipments, and the outlook for the next quarter also showed a slower growth rate. That's what leads to a lower stock price and lower expectation. But when you look deeper into what's going on, and so this is where kind of the magic happens, when I read the 2Q25 earnings transcripts, I see that they talk a lot about backlog. Now, what is backlog? It's the orders that they've already received from customers, but they haven't delivered and produced yet. So it hasn't actually shown up in revenues. Now, they were talking about they have backlog of about 4.5 billion. Their trailing 12 months revenues are about 2.8. So that's a pretty big numbers, and that usually is delivered over 2 years per the company. So that means the company's revenues should reach 4.5 billion in, within 2 years. And that's almost a 50% growth from that 2.8 billion number. So that's a lot of growth. That's not really being priced in. The analyst estimates, you can see, have come down pretty significantly the prior year. To reflect those delays, you're looking at estimates have gone from now they're for fiscal 2025. You can see that they're $3.26. 26 is $3.37. So two things. One, they've come down. And two, you can see that the growth rate from fiscal 2026 from fiscal 2025 is basically just showing flat growth. It's just single digits, right? And remember, if they're going to deliver that backlog, I mean, that should at least produce maybe 15, 20% type growth rates if it's going to be 50% over the next 2 years, right? So this is what I mean by low expectations. And this is where the magic is happening, because now we see growth in the company that the market is not pricing in, it's not realizing yet. And so that's where a lot of opportunities start to create themselves with stocks. The third thing to look for is a discounted valuation. Now, why do we want a discounted valuation? Of course, it's nice to have a cheap stock, but the reason why is because that really brings lower risk for us as investors. One, it means that there's low expectations anyway. So if the company, for whatever reason, has slower growth numbers like everyone's expecting, it's not going to impact the stock too much. It's already been priced in. The second reason is that if it's at a low multiple, there's also an opportunity for it to rise if it reaches a more normalized multiple that represents the growth of the company. So there's three things to look for when you're looking for discounted valuation. One is that the multiple is just below the historical trend. Two is that the valuation is not reflecting any growth. And third is that the PE multiples or the valuation multiples that you're looking at are a lot lower than their comparable companies, or what we call comps. So when we look at Nextracker, so that's the blue line on the bottom, you can see that when they had that fast growth period, their PE multiples were closer to 15 to 18 times price to earnings multiple. That's been coming down. Now it's closer to 11 times right now. So if we assume that the company is growing at 15, 20%, that PE multiple is likely too low. And also when we compare it to a comparable company like Enphase Energy, so that's ENPH on top, that's trading at closer to 20 times. Now, this company is also in the solar space, but slightly different. They do energy management, they do storage, but they have a similar growth profile. So there might be some reason why they should be a higher valuation, but that range is probably a little too wide. So arguably, this multiple for Nextracker could probably go from 11 times to maybe 15 times just when it gets back up to more of a growth type multiple. So once we've identified an opportunity, we also want to figure out the timing. So we want to understand what is the catalyst that's going to revalue the stock? What's the information that's going to actually change expectations, and when is that going to happen? So these are some of the common catalysts that I've seen in a lot of stocks. One is that there's a change in the earnings growth rate, so an acceleration or deceleration. That's usually an important signal to investors. Second is if the guidance or outlook is changed, especially if it's raised. That's usually a big one for changing expectations. And third is looking at the key performance indicators, so the KPIs, looking at things like growth in subscriptions, right? If it accelerates or decelerates, also pretty meaningful signals to the market. When I look at Nextracker, I think the catalyst is pretty clear. It's going to be the outlook. So they include their outlook for the business in every earnings release. And the reason why I think that's the catalyst is because when we look at the earnings outlook for 2Q, right, when growth slowed, can see that the earnings outlook was $3.10 to $3.30. And then the analyst estimates were $3.26 for FY 2025. So the analyst estimates were right in the middle of the guidance range, which tells us that the outlook is driving expectations in terms of the estimates from analysts, and that's likely driving the expectations for the stock. So if we think that their growth is probably going to be better than expected, what we should see is an outlook that's showing a higher EPS. And that will raise estimates, that'll raise the expectations of the stock, should raise valuation at some point, and that'll bring up the stock price. Okay, so now we just need to estimate the specific prices. So my outlook was for a $57 target, represents about 60% upside from that $36 price. I expected that to happen at some point in 2025, maybe mid to late 2025. So that was based on a forecast for EPS growth of about 15%. So that estimates out to about $3.84. That's the fundamental reason. Expected analyst estimates to also rise to reflect that. So they're currently at 327. I think it can get to 384. And finally, valuation. The PE ratio is 11 times. I think it could probably get to maybe 15 times. Take that 384 EPS estimate, multiply by a 15 multiple, gets us to about the $57 stock. Now, from a downside perspective, say that they don't actually realize any growth. So probably just use the analyst estimates. So that's 337. If I use a 10 times multiple, that's kind of at the low end of their range. That would represent a $34 stock. So I think most of the downside is priced into the stock, unless, of course, the company actually starts to contract and have declining earnings, in which case downside would be more. The catalyst would be the updated outlook in the earnings release. So that I expected would maybe 3Q or 4Q, depending on which outlook would show better growth. But some point in time between the end of 2024 and mid 2025. Okay. So now the cool thing with options is now we can increase that 60% return to 100% return, because with options, we don't have to pay as much to buy the stock. In this payoff structure of using options, I'm only risking about 1,200 to potentially make about another 1,200. So about 100% returns, because I'm buying the equivalent of about $3,000 to $4,000 in stock. So I'm getting leverage. Now to do this, I'm going to give you a brief primer on how options prices work when you see like this list of numbers, so you understand what that means from a basic level. So the option that I was looking at is the August 15th $30 strike call option. So what that is, if I buy that option, it's the right to buy Nextracker's stock at a $30 price. So that would be the strike price. And I picked August just because if the stock's going to revalue some point mid to late 2025, then it should revalue by August. So the price of that option is $10.62. It's also called the premium too. So you pay $1,062 for the right to buy 100 shares of Nextracker stock at $30. So that option premium is comprised of two things. It's got the intrinsic value and extrinsic value. The intrinsic value represents the value if we exercise the option today. So if the strike price is 30, that means we exercise the option, we can buy the stock at 30, we can immediately sell it back to the market at 36. So the intrinsic value would be $6. So 36 minus 30. Now the extrinsic value represents the additional premium that you're paying. That represents the probability of the stock both rising and how far it can rise. So we take that 1062 premium, we minus the $6 in intrinsic value, that gets us to about 4.6 in extrinsic value, right? So the extrinsic value is also called time value. That'll eventually go down to zero, right? Because as time goes by, when you have less and less time, there's obviously less probability that the stock will get to a higher price. That's also called time decay. So if you're looking at an options pricing, you can look at the Greeks. So that just represents the characteristics of options. You can look at the theta. And so theta represents how much that option price will go down each day. So then in order to have a profitable option investment, if you're buying something like a call option, you need to compare the premium paid, so that would be the risk, versus the expected change in the intrinsic value. So just the price movement of the stock, the change in the stock price. So now to illustrate, just to make that more clearer, this is the payoff of a 30 strike call. So the right to buy at $30. This option will only really start to make money if the stock gets above 42. Why? Because we're paying $4.60 in extrinsic value or premium. And so the price of the stock has to move enough to cover that premium. So how do we make money with options? At a high level, every option position really represents a trade-off between market movement and the cost of time decay. So to make a profit, really it just comes down to the profit equals the change in the intrinsic value, so the movement of the price of the stock minus the cost that we pay in time value. And this is why, just as a warning, some people I've seen have bought call options on a stock and then it goes down when the stock goes up. And the reason why that is because they paid too much in premium. So the change in the stock price wasn't enough to offset how much premium they paid or time value they paid in the option. Okay, so the key to buying an option profitably for a stock is we want to look for three things. One, you want to make sure that there's a big move. So we need enough price movement to offset that time value. Second, you want to identify the timing of the move because you want to structure the options around the time when the stock will revalue and also limit your holding period. And so that's same with the third point. You want to limit your costs of holding the option. So limit the time decay or theta as much as possible. Okay, but the cool thing about options is that if you're smart and you pick the right prices, you can start to change your risk and reward payoffs to make it more optimal. You can reduce the risk by limiting the premium that you pay, and you can also increase the amount of return that you get, kind of bending it and creating a higher payoff if the stock moves in your favor. So I'm going to show you how to do that right now using a option payoff calculator so you can see how it's done. So with this sheet, I'm going to show you the payoffs for different option structures. And by the way, I'm going to give you a link in the description so you can email the sheets you can use to play around and structure your own trades. Okay, so now here's how this is set up. We got our stock price. We put in 36 over here. That's the price that it was before the earnings release. I put our options that we're going to look at as well as the prices. So we got the August 15, 2025 30 strike options over here. And I'm going to also look at the May 16, 2025 30 strike options. I'm going to show you that in just a second. So what happens if we buy one of these calls of the August 15, 2025 30 strike calls? Well, we can see that we have a total risk capital. It's just summing up the net premium, as well as time value of 463, just summing up the net time value. So that would be the value that the 463 is guaranteed to go to zero. It's a guaranteed risk if the stock price doesn't move. So I'm going to assume that the stock's going to trade between 25 and 60 by expiration to show the different potential outcomes and to calculate the payoffs. If it gets below 30, we're basically losing all the premium that we pay. The option expires worthless. And that this option really starts to make money if we get above 40. So you can see that we need to start to pay off that extrinsic value. And once it gets to 50 and beyond, that's where we really start making money. We're getting 1,000 to 2,000 in returns and 100 plus to 200 type of returns. And now we can look at the risk capital. So now I'm just taking the total premium paid relative to that max payoff. So if it gets to 60, and just comparing the risk and reward. So here we get close to a 2, putting about 1,000 down. Max payoff, if it gets to $60, is about $2,000. And you can see over here, it's kind of it's just a linear payoff. If the stock price moves up, then the call value will go up as well. Okay, now let's say we wanted to offset some of that time value that we're paying. We can sell a May 16, 2025 call. Now, why do we sell a May one? Well, because the the time decay is faster for shorter expirations. And so because I wasn't really sure when the stock would revalue, I figured sometime mid-year. So I figured maybe it might be after May. So I would sell the May calls to offset the time value, the holding cost, while still being positioned for potential upside exposure after May. So now the max risk is just 142. We're basically offsetting most of the premium with this short call. Now, the other thing about this, so assuming if the stock gets to 50, the plan would be to close out the May 16 calls, right? There's no use for them anymore. Stock is already revalued. We don't really need it to offset the time decay, and it's starting to have a loss, obviously, as the stock goes up. So we sell it at 50. So basically I cap the loss at that level, assuming we close the option at a $50 price. So now our risk is basically 142, right? On the downside, no matter what happens. And as long as we close the 50 call, right, we start to make money with this combination of this option position. So now with this combination, our break-even point is basically a little over 50. That's when it starts to make money. And when it gets to, closer to 60, that's when we start to make the serious returns. So about 1,000 plus. And the returns are actually super high, 600, 800%, because we're making 1,000 off just putting 142 down. Obviously, assuming if the stock gets to 60s. Now we get a huge risk reward payoff, almost 9 times, because we put down so little risk capital. And if the stock actually gets to 60. Now, what if we wanted to combine the two, right? Because this one has such a high break-even point. What if I added another call? So I'm going to add in another long call. So now I have a ratio. I have 2 of the August 15, 2025 calls, 30 strike calls. I'm selling one May 16, 25, 30 strike call. Now I'm paying a total premium of about $1,200. The value or the time value at risk is about $600. And again, decide I'm going to close the May call if the stock gets to 50. Okay, so now our max risk, if the stock gets below basically around 30, we basically lose $1,200. So that's our max risk exposure. But now our break-even point is again probably at this 42 level. We start to make a profit. Now here we start to get a lot more upside. So if the stock gets past 50, we're getting to 1,000 to about 3,000 plus in dollar amounts. That represents, anywhere between 100 to almost 300% type of returns. You can see that we've kind of bent our stock, our upside exposure. We have steeper upside exposure, and we bent the downside exposure too. So I think it's really cool because, we're paying just $200 more versus just having a single long call, but we can have a much higher net payoff if the stock gets to 60. So now our risk reward is closer to 3 times. Cool, right? So this was just my preference. I chose to do this combination, but you can really get creative with this. And, if you have a bigger account, you can just add a 0, or even more. And the thing is that this stock trades about $100 million a day, so it can easily support 1 to 2 million in buying. If you want to think about what is the equivalent stock that you're really buying with the option, you can look at the notional exposure. So it just represents the contract size times the actual strike. So this, if you're buying 20 calls, you're basically buying $72,000 in stock. So the great thing about investing, like I said, scales well. So this is cool, right? So I'm going to put this in the link in the description, share with you so you can use this to play around to figure out cool option structures that can really get you good risk to reward type of ratios and really define the risk that you want to take. So now let's see how this investment plays out. The earnings were reported in January 28th, 2025. So about 30 days after the December 30th transaction that we did. And so this is the 3Q earnings. You can see that they provided an updated outlook, and you can see guidance has been raised. See the expected earnings for fiscal 2025 are at $375 and $395 versus the $310, $330 in EPS. So that's up 18%. That's great. So the outlook for the company is improving. That's exactly what we want to see and what we anticipated. So I didn't think it would happen so soon, but this is why it's good to be prepared. And that's also the kind of neat thing about options is you have the option. So let's see what happens immediately after the stock announcement. Well, the stock increases 27%. Why? Well, if we look at the earnings estimate, they were about $3. So for the $3 for the next 12 months in earnings per share, that jumped to $3.74. So that's a 24% rise. So that directly matches the stock price rise. You can see the expectations are moving the stock price up. right? And we look a little bit deeper into the different estimates for the different years. You can see that the earnings estimates basically have risen all across the board from fiscal 25 to fiscal 28, between 12 to 17%. So that's a sign that this catalyst is brought up expectations as a whole for this company. You can see the fiscal 2026 estimates, they went up to 382, right? Remember, we were estimating 384, so right on the ball. So it looks like the expectations are moving up as we expected them to. And the funny thing is, if you look at fiscal 2025 estimates and fiscal 2026 estimates, they're the same. So no growth is expected. So that means if the company keeps performing like this and reports a better outlook next quarter, we will probably see another revaluation. So just keep an eye on it. All right, so how much are we actually getting paid? What's our profit from this option combination? Well, we risk about $1,200, and that's because we paid about $2,132 for a premium for 2 August 15 30 strike calls. And we offset some of that by selling 1 May 15 30 strike call for $920 premium, so net risk capital of about $1,200. Our profit is also $1,200 because we closed the May 15 30 strike calls. We bought it back. That was a $1,000 loss. And now we're holding 2 of the August 15 25 30 strike calls, and now they're about $2,250 in profit. That's what you saw in the brokerage statement earlier. So our net profit is about $1,200, and that's a 100% gain in 30 days. So honestly, I got a little lucky with this one, but that's how you make 100% in just a short time period. Cool, right? So I really love this stuff. When I first started investing, I would always, I'd hear about people buying a stock and be like, oh, I made a double, right? 100%. And I've always wanted to do that. It took me so long to ultimately get there. And now I've done it a bunch of times. And it's great, but really it's not about the money anymore, because I just find it so fun. When you get it right, you see the stock revalues, but also if you get it wrong, it's very painful. But it's cool because you are reading about companies. There's always new type of investments. There's new exciting stories, and you really get paid on your thinking and making good decisions. So I think it's one of the funnest games to do, and it's awesome. So if you're interested more in like the financial analysis, I actually did a video on Nextracker's financials. And if you want to learn more about how to use a fundamental analysis type of approach, I actually put together a full course on using this fundamental approach to pick stocks, everything from the financial statements going all the way to research to actually making a decision and pricing the stock. I'm going to include a link to that YouTube video in the description below. And if you're interested in our education program, right, like I told you, I love teaching this stuff. You can check that out in the description below, as well as a link to that option payoff calculator that you just saw, so you can download. I will email it to you as well. Thanks for watching, and I will see you in the next video. Is a backlog.